So what in the heck is dollar cost averaging? Well, in the industry, we call it DCA. And so anytime you see those initials DCA, or it means dollar cost averaging. So it's a powerful strategy to help you improve and increase your results as you invest in the stock market. And I'm sure you could probably, quite frankly, use the same concept in any investment that you use. So let's jump right in and find out what dollar cost averaging is, how it works, and then I want to give you an example of how I've been using it in my own portfolio. Welcome to the channel. My name is Paris Clough, and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money, and I'd love to help you do the same thing. So what is dollar cost averaging? Well, in a nutshell, and I'm going to explain a little bit more detail, and I'm going to give you an example, and then I'm going to share with you actually my own personal portfolio. But basically, dollar cost averaging is taking a dollar amount that you can afford and you put it into the market at regular intervals. So let's say that you have $100 a month that you can put in. Well, as long as you're putting in it every month about the same time, that's called dollar cost averaging. You're putting money in regular intervals, and whether it's every week, whether it's every month, whether it's every quarter, the more often that you do it, the better. And you pick the dollar amount. Is it $5 a week? Is it 10, 20, 100, 200, 1,000? Whatever dollar amount it is, just keep that consistency going. There's an old saying that says, it's not about timing the market, which means finding out the highs and the lows and the fluctuations of the market, but it's time in the market. So a lot of people will ask me, when was the best time, or when is the best time to invest? Well, the best time to invest was 20 years ago. The next best time is today. So let's make sure that you're investing as soon as possible with as much money as possible. Now, some people have a large lump sum of money. If you have a large lump sum of money, should you dollar cost average? Well, if you're nervous about putting all that money into the market all at once, then yes, you should dollar cost average into the market. Now, if you have a paycheck that you're getting and you have a positive cash flow because you've done your budgeting and you know that you can afford a certain dollar amount every month, then you put money into the market as you get paid. And that is also dollar cost averaging. Now, what's neat about dollar cost averaging is it takes advantage of the peaks and the valleys that the stock market invariably has. History has shown that the stock market goes up and down and up and down. However, there's generally an upward trend. I like to explain it like this. Imagine, if you will, a young man or a young woman with a yo-yo, and they're walking up a hill. As that yo-yo goes up and down and up and down, and they continue to walk up the hill, the down of the yo-yo will actually be higher each step they take up that hill. So that's the same with the stock market. As the stock market goes up and down, the downs, as they continue that upward trend, will be higher than the previous downs. Well, at least that's how it's supposed to work. So let me give you an example of how dollar cost averaging works, and then I'll share with you in my own portfolio what I've done to use dollar cost averaging to increase my portfolio. So I've created this Word document, and this Word document explains dollar cost averaging. So let's say that you have $100 a month that you can put into the market. So in January, you have $100 that you want to put into the market. The cost per share is $10, so that means you can buy 10 shares. 10 into 100 is 10. Simple math. The next month, however, you have the same $100, but the price changed. Now you've gone down. You actually lost money, so it seems. And so instead of buying 10 shares, you can actually buy 11.1 shares. So here comes the magic. As you buy more shares, you're averaging down the price of the shares that you have, which will end up giving you a better price and a better portfolio value as the market comes back. As it goes down and then comes back up, you're going to have a much higher portfolio value because of that. So in March, you save the same $100. It's $8 a share now, 12.5 shares. In April, $100, $9 a share, 11.1 again. May, $100, $7 a share, 14.3 shares that you're buying now. June, $100 at $6 a share. Now you might be saying $6 a share, my goodness, I've almost lost half the amount of money that I had. Well, no, because you're buying more shares. You want to be buying more shares. You're owning more shares. You own more. You're literally buying at a discount. You're buying more shares at a lower price. In July, you have $100, $8 a share. You have 12.5 that you bought. August, it goes back to $10 a share at $100. Now you can buy 10 again. September, it goes up to $12. You can buy 8.3. In October, it's 13. You're buying 7.7. $11 in November, 9.1 shares. In December, it's $12 a share, and you bought 8.3 with your $100. So you put a total investment here, as it shows here, of $1,200. That's your total investment. And I'm going to share with you in a minute the difference between having taken this $1,200 and put it in at $100 intervals every month, or what would have taken, or what would have happened had you put in all $1,200 in January. So over here, you see the total number of shares that you own is 131.6 shares. So you take that 131.6 and you multiply it by 12. That's the current value of the stock. And that means that your total balance right now is $1,579.49. That's a fantastic return on your money. So let's just take a look at as a comparison. If you had taken all $1,200 and just invested it at $10 a share, you would have bought 120 shares, because $1,200, $10 a share is 120 shares. So that would have, at 120 shares, with a price today in December, because we're in December now, of $12, 12 times 120 is $1,440. You can see it's $139.49 less than using dollar cost averaging, because you averaged down your price. That's why it's called dollar cost averaging. You're averaging down the dollar amount of the value of that stock as you buy shares that are lower and lower. As you're buying more shares, using the same dollar amount, buying more shares, averaging down the cost as the price of that stock comes down. That way, when the price of the stock comes back up, you're able to take advantage of that new value. All those shares that you bought at that lower value now have much greater value because they're at the $12 range. So you bought all these shares that you bought at $6 have now doubled their value at $12. That makes sense? Don't do this with a stock that's going to go under. Make sure this is something that you're doing with strong, solid stocks. Or what I like to use is the index, because the index is a fantastic investment for this type of investing, because you know that the index invariably goes, it has an upward trend, and 80+% of money managers can't beat the index. So if you're out there picking individual stocks, you might pick one that's going to go under. So just be careful about that. This works on those big, those solid companies, those companies that aren't going anywhere. You do the research, you do the look at the financials, pick a good, strong company, and you're going to be just fine. If you're not interested in doing that, pick a good, strong index like VTI, VOO, S&P 500. Pick any one of those S&P 500 funds, regardless of who does it or who manages it. Just pick a good index fund, and you're going to be in great shape. So now I want to share with you my personal example, how I use this in my M1 Finance portfolio. Now, my M1 Finance portfolio is where I put all my ETFs. I have a couple individual shares there and a couple individual stocks that I like to have. So I'm going to share with you how I use M1 Finance. Okay, so for those of you who are not familiar with M1 Finance, I highly recommend you click the link in the description below, open up an M1 Finance account. If you fund it with $100, I believe right now they're giving you 20 or 30, or at one point they were giving away $50 for everybody who clicked the link and who opened up an account with M1 Finance. For me, M1 Finance is a fantastic company that you can use to set it and forget it and kind of just have it on autopilot. I love M1 Finance for that very reason. So let me share with you what I'm talking about. So this is my portfolio. M1 Finance has pies, and each pie has a slice. And then each one of these slices actually breaks down. Let me show you. These slices will break down into their own pie. And then you can have slices here. So M1 Finance deals with pies and slices. It sounds pretty yummy, doesn't it? Anyways, so if you look over here, you'll see a percentage. So each one of these, this percentage is a percentage that I set. So every dollar that goes into this portfolio, 25 cents goes into my REIT ETFs, 25 cents goes into my index funds, 24 cents goes into my dividend ETF fund or pie, 9 cents goes into my growth stocks, 9 cents goes into my M1 rewards, and 8 cents goes into my ARK ETFs. So as you can see, you can set whatever percentage you want. You can have as much in one fund or one pie or slice as another. You can pick and choose whatever happens. And then what's neat about M1 Finance is they allow you to do what's called automatic investing. So you can automatically put money in every week, every month, whatever you choose. You get to pick. You can do it every day. You can do it every week, every month, twice a month. You can pick and choose how often it goes in there. So I personally have, let's click the activity tab here, because I personally have every Tuesday. Let me show you. So I'm going to do deposits and withdrawals only. So you can see every week, every Tuesday, I deposit $100 into my investment portfolio. And so this particular week, I had some trades, and let's take a look at those. So In this fund, this one of the things I like about M1 Finance is they allow you to buy what are called fractional shares. A lot of the portfolios allow you to do that. I mean, all the platforms, allow you to do that right now, I'm pretty sure. So fractional shares are nice because they allow you to buy whatever you can with the money that you put in. So for example, SPYD, which is an S&P 500 portfolio. So right now I put in $7.80. So when I put in that $100 this week, $7.80 of it was allotted to SPYD. And the share price of SPYD right now is $39.74. So I was only able to buy 0.19627 shares. So that's a fraction of a share. And because I am allowed to do that on M1 Finance, I'm able to buy whatever I can with what money I can. So some of you might say, well, I don't have a lot of money. Does it make a difference? Yeah, get what money you can in there and buy fractions of shares if necessary until you can build up to the point where you have a full share. And then as you build up your habit of saving money, and you'll start putting more money in, and you'll get excited and you'll build some momentum, and eventually you'll be able to buy more and more shares with each one of your deposits and each one of your contributions. So let's take a look at this other one here. So I put a little bit more money in COMT, which is commodities. So it's $44 went into this one, and the price is $38. So I was able to buy more than one share. So about 1.14135 shares. So as you can see, it doesn't necessarily matter if you have enough money to buy a share or not, or buy 2 or 10 or whatever shares. Just put what money in you can and buy a fraction of the share so that you can take advantage of owning that stock. And eventually, as you continue to contribute, as you continue to dollar cost average, you're going to own more and more shares as you own more and more fractions of the shares. So let's take a look here really quickly at my portfolio. As you can see, right now my market gains are minus 4,000, so I'm down almost 31%. Well, with dollar cost averaging, is that good or bad? Answer in the comments below. When the market is going down and you're in a dollar cost averaging strategy, is it time to buy or time to sell? If you've been following along and paying attention and you've been understanding this correctly, you'll know that as the market goes down, it's time to get that money in there to continue buying into the market, because you're going to buy more shares of the same stocks that you've been buying. And as the value goes down, you buy more and more. And then as the value comes back up, you have more shares at the higher price, and you can take advantage of now having a higher value in your portfolio than you would have had you lump summed it at the beginning of that. So highly recommend dollar cost averaging. If you have whatever dollar amount you have, get it into the market. And I do also recommend lump sum investing. However, dollar cost averaging is a great way to get into the market and take advantage of these ups and downs as you invest money at regular intervals into the market. Before I let you go, I just want to quickly remind you about my Facebook page. If you'll come over to the Facebook page at Financial Self-Reliance, click more, click groups, and you'll join the group Manage, Protect, and Grow Your Money, Personal Finance and Investing. I'd really appreciate it. So I hope that you got a lot out of this video. If you missed the last video I produced, you can find it here. Go ahead and subscribe to the channel up here. And if you want to catch the video that YouTube thinks you might like, go ahead and catch that one up here. Until the next time, have a great day, and I look forward to seeing you on the next video.